Okay, let's dive into this. We've got a company's recent earnings results and their forward-looking outlook here.
Yep. Investor presentation, press release, the usual suspects.
Exactly. So our mission today, pull out the key financial bits from Q1 of their fiscal 2026 and, really understand what they're projecting for Q2 and the full year.
Right. See what story the numbers are telling us.
Mm,
And what jumps out right away, I think, is just how clear these sources are. Strong Q1, which wrapped up April 30th, and then pretty specific targets for the rest of the year.
yeah, absolutely. Let's hit those Q1 specifics first because that growth is, well, it's hard to miss. Subscription ARR, that's annual recurring revenue.
The predictable stuff.
Right, the predictable part. Hit $1.18 billion. That's up, what, 38% year over year? Pretty substantial.
The total revenue figure,
Yeah.
even faster growth there. $278.5 million total revenue, up 49% compared to last year's Q1.
49%. Wow.
Yeah. And if you dig into that, subscription revenue was the big driver. Grew 54% to $265.7 million.
So that's now like 95% of their total revenue.
Exactly. 95%. That
Yep.
shift in the mix, that's a really key signal, I think.
Definitely leans into that predictable subscription model. Okay, and profitability. Non-GAAP gross margin saw a nice bump too, right?
It did. Improved to 80.5% from 75.4% last year. Shows better core profitability on their sales, excluding certain items.
But the really big story, I think, maybe the most significant swing, was free cash flow.
Oh, absolutely. Free cash flow,
Yeah.
the actual cash the business generates after costs and investments, it's swung dramatically.
How dramatic are we talking?
Well, it was positive $33.3 million this Q1. Compare that to negative $37.1 million in Q1 last year.
Huge turnaround. That gave them a 12% free cash flow margin for the quarter.
Right. And tied into that, the subscription ARR contribution margin also flipped positive. It was 8.0%, up from negative 10.6%. So you're seeing that operating leverage improve as they get bigger.
Okay. And they're still adding those bigger customers too.
Yep. 2,381 customers now spending $100,000 or more in subscription ARR. That's up 28% from last year. Solid growth there.
So Q1 definitely looks like strong momentum, growth, efficiency improving. Okay, so what about looking ahead, the guidance for Q2 and the full year?
All right, so for Q2 fiscal 26, they're targeting revenue between $281 million and $283 million.
Okay.
And they expect a non-GAAP subscription ARR contribution margin of 4.5% to 5.5%. They did specifically mention seasonality, though.
Ah, right. Margin's expected to be a bit lower in Q2 and Q3.
Exactly, before ticking back up in Q4. That seasonality seems important for their model.
Makes sense. It often impacts cash flow too.
So what's the full fiscal year 2026 outlook then?
For the full year, they're aiming for subscription ARR between $1.3830 billion and $1.388 billion.
Okay, quite a range there.
And total revenue between $1.179 billion and $1.189 billion. For the full year contribution margin, they expect around 6.0%.
Around 6%. Got it. And bottom line, profitability, cash generation for the whole year. Well, non-GAAP EPS is still guided as a loss between negative $1.30 and negative $1.96 per share.
Still a loss on EPS. Interesting. But what about cash?
But critically, they are projecting positive free cash flow for the full year, targeting between $65 million and $75 million.
Okay, so positive cash flow for the year, despite the EPS loss guidance.
Right. And they flagged that seasonality again, expecting Q2 free cash flow to be roughly break even, then Q3 higher, Q4 higher again to hit that positive full year target.
Okay, so pulling it all together. Strong Q1, accelerating growth, much better efficiency, particularly on cash flow, and then a clear roadmap for the year aiming for positive free cash flow overall, even with those seasonal dips expected.
Yeah, that's the picture. The trajectory, just based on their numbers and guidance, it really suggests the business model is hitting a point where growth translates more directly into, operating leverage and actual cash generation, which does raise an interesting question, doesn't it? You've got this projected full-year EPS loss, but positive free cash flow. What does that specific financial, let's say, sequencing tell you about the underlying profitability and maybe the capital structure of the business long term?
Right. That difference between accounting profit and actual cash generation is always key to unpack. So for you listening, what does this all mean as you think about this company's path? It's a narrative of recent strength meeting a guided future, navigating those seasonal bumps toward annual financial targets, something to chew on.